All right, welcome back to another High Yield Explainer. Today, we're doing exactly what you've been asking for. We are tackling a massive stack of past business and company law paper questions. We're going to focus entirely on reading the actual exam prompts and handing you the exact, precise answers you need to score top marks. Let's get you from stressed to exam ready. Here we go. To keep things moving, here's our game plan for today. We're covering 6 main areas: partnership definitions and types, partnership operations and authority, dissolving a partnership, understanding company structures, company shares and contracts, and finally, the winding up process. Let's jump straight in.
Section 1. Partnership definitions and types.
Okay, pull up your past papers. We're looking at Section A. Here is the first prompt right off the page. Question A asks, outline 2 distinctions between a cooperative and a partnership for 2 marks. Let's lock those in. To secure those 2 marks, you just need the core structural differences. Listen, a cooperative needs at least 10 members, right? And everyone gets exactly 1 vote no matter their shares, plus they usually have limited liability. A partnership, though, that's just 2 to 20 people. Voting depends totally on whatever you agreed to in your partnership agreement, and the liability is usually unlimited. Give the examiner any 2 of those differences, and boom, easy marks.
All right, flipping over to question 4A. This one asks you to differentiate among any 4 types of partners for a massive 8 marks. You absolutely have to have these memorized. First up, the general partner. They're active in management and have unlimited liability. Remember the classic Cox vs. Hickman case? Sharing profits isn't enough. You really have to intend to do business together. Then we have the sleeping partner, totally inactive but still on the hook for debts. Third is the limited partner. Their liability is capped at what they invested, but only if they keep their hands out of management. And lastly, the salaried partner. They just get a fixed wage and aren't really a true partner unless they're getting a cut of the profits too.
So how do you stop all these different partners from constantly being at each other's throats? Well, that brings us to question 2A, a classic 5-mark prompt. Define partnership deed. You want to tell the examiner that the partnership deed or articles of partnership is a written agreement setting out the rules of the game. For all 5 marks, you got to list what's actually inside it: the firm's name, who contributed what capital, the profit and loss split, partner rights and duties, and the rules for dissolution. It is literally the constitutional rulebook that stops messy internal disputes. Now, what if you don't want to deal with partners at all? Let's look at question 2C. It says, discuss 4 differences between a sole proprietorship and a partnership. 10 marks here, folks. First up, ownership. It's 1 person versus 2 or more. Simple. Second, decision-making. The sole owner calls all the shots alone, while partners have to share that power. Third is the financial risk. A sole proprietor eats all the losses but keeps all the profits, whereas partners split the whole pie. And fourth, continuity. A sole proprietorship legally dies with the owner, but a partnership, that can keep going depending on the agreement. Moving on to Section 2, Partnership, Operations, and Authority. Let's hit question 4C. It asks you to explain the relationship of partners to each other using 3 examples. This is worth 7 marks. The magic phrase you need here is fiduciary relationship, utmost good faith. The 3 examples they're looking for: number 1, the duty to render true accounts. Number 2, the duty not to make secret profits. Think about the absolute audacity in the Bentley vs. Craven case, where a partner secretly sold his own sugar to his own firm at a huge markup. The court obviously made him pay all that back. And number 3, the duty to disclose competing interests. So, what happens when that good faith goes out the window? Let's check out question C from Section A. This is a 7-mark scenario where a guy named Matthew takes out an unauthorized loan from Big Loan Limited for his car rental partnership with Thomas. He did this even though they had a private agreement forbidding it. The prompt just says, advise Big Loan Limited. Okay, we're going to use the prompt and conquer method here. Step 1, the issue. Can Big Loan get their money back? Step 2, the law. Every partner acts as an agent in the ordinary course of business. Step 3, the case law. Mercantile Credit Co. Ltd v. Garrod. And Step 4, the application. Because getting a loan looks like normal business to an outsider, Thomas is on the hook. Big Loan Limited will almost certainly succeed. And look at how perfectly that ties into question 4B, which asks, discuss the case Mercantile Credit v. Garrod and explain its rationale for 10 marks. Here is the absolute critical takeaway you need to write down. Private restrictions hidden inside a partnership agreement mean absolutely nothing to a third party who doesn't know about them. In that specific case, a sleeping partner got hit with the bill because selling cars looked like the totally normal, ordinary business of their garage. To the rest of the world, a rogue partner still has implied authority.
All right, Section 3, dissolving a partnership.
Sometimes things just completely fall apart. Notice how question 2b and 4a both ask the exact same thing. Explain 5 grounds for dissolution of a partnership. They are throwing 15 marks at this, so pay attention. Here is your definitive 5-point checklist. 1. The expiry of a fixed term or project. 2. A partner simply giving proper notice. 3. The death of a partner. 4. Bankruptcy. And 5. The business becoming straight up illegal. There is a wonderfully ironic case here. Hudgell, Yates & Co. v. Watson. A literal lawyer forgot to renew his practicing certificate. It legally made the firm illegal and forced the whole thing to dissolve. You can't make this stuff up.
Now, the second part of question 4b asks, outline how partnership property is applied on dissolution. Please don't just say split the cash. You have to give them this exact step-by-step hierarchy. First, you pay off the outside creditors. Second, you repay any loans the partners personally made to the firm. Third, you return everyone's initial capital contributions. And finally, you distribute whatever profits are left. And keep in mind, all profits, even those sneaky secret profits clawed back under the Bentley v. Craven rule we just talked about, go straight into this pot to be divided up fairly.
Let's shift gears. Section 4, understanding company structures.
We're moving up the corporate ladder now. Question 2, Part A, is a solid 10-mark prompt asking you to outline 5 distinctions of a public company in comparison with a private company. Your answer should be these 5 pillars. 1. Public invitations. Private companies are strictly forbidden from inviting the general public to buy shares. Public companies literally use a prospectus to do exactly that. 2. Shares. Private shares are restricted. Public shares trade freely. 3. Membership. A private company needs a minimum of just 1 member, while a public company requires a higher baseline. 4. Structural suffixes. Private ends in Ltd, public ends in PLC. And 5. Financial instruments. Public companies can issue debenture stock to global investors, but private companies definitely cannot.
Moving right along to Section 5, company shares and contracts.
Okay, question 2, Part B asks you to explain ordinary shares, preference shares, and authorized shares. This is worth 15 marks, so don't skimp on the details. For ordinary shares, you want to state that they represent residual ownership. Yes, they carry the highest risk, but they also give you full voting power. For preference shares, explain that it's kind of a hybrid capital. It gives you priority over ordinary shares, usually meaning you get a fixed dividend paid out before anyone else sees a dime. And for authorized shares, just tell the examiner this is the absolute legal ceiling, the maximum number of shares a company's constitution actually permits it to issue.
Let's flip to Section A, Question D. It's worth 9 marks and asks, explain the principle that the Articles of Incorporation has the binding force of a contract. You need to break down the statutory contract principle. Make sure you cite Hickman v. Kent. That case proves the articles bind members specifically in their capacity as members, meaning they have to follow internal rules like arbitration. But, and this is a huge but, you must mention the limitation. You cannot enforce rights under the articles if those rights have nothing to do with membership. For instance, you can't use it to demand a job as the company's solicitor.
And here we are at the endgame. Section 6, the winding up process. Question 5, Part A, hits you with a quick 4-mark definition. Explain the concept of liquidation or winding up. Your answer. It is the strict legal and statutory process of dissolving a corporate entity. Remember, a company is a separate legal person. It doesn't just die of old age. You have to appoint a liquidator to realize or sell off the assets, pay the debts, and formally terminate the company's existence.
Following right up on that for another 15 marks is Question 5, Part B. Explain the different grounds on which a company may be wound up. You got to give them these 5 grounds. First up, insolvency. They literally cannot pay their debts. Second is the court's just and equitable power. Courts usually pull this lever when there's a 50-50 management deadlock or some crazy fraud going on. Third is a special resolution passed by a 75% majority of the members. Fourth is the expiration of a fixed time frame set in the company's rules. And fifth, if the membership count drops below the legal statutory minimum.
All right, final question. Question 5, Part C asks you to outline the priority of claims in liquidation for 6 marks. You absolutely must write down this exact, unalterable statutory hierarchy. First in line, costs of liquidation, because the liquidator gets their fee first, obviously. Second, fixed charge holders, who get paid from specifically locked assets. Third, preferential creditors, which covers things like unpaid employee wages and taxes. Fourth, floating charge holders.
Fifth, unsecured creditors, like your standard trade suppliers. And dead last at number 6, the shareholders. They only get whatever residual scrap is left over, if there's even a single cent to be found.
And just like that, we've officially conquered every single question on this past paper. We read the prompts straight off the page, and we gave you the precise answers the examiners are begging to see. But hey, beyond just acing this exam, take a step back and look at what you've learned. From the handshake of a simple partnership, all the way to the rigid statutory hierarchy of corporate liquidation, you now possess the blueprint of the invisible legal frameworks holding the entire global business world together. So the only question left for you is, are you ready to walk into that exam room and crush it?